Lentus Asset Management follows the bottom-up value philosophies pioneered by Benjamin Graham and David Dodd when compiling portfolios. Looking for often unloved and undervalued securities, Nic Norman-Smith, portfolio manager at Lentus Asset Management, joins us to try and find value in a volatile market. And let's compare here the general retailers, which are up just over 10% year to date, and the resource 10, which is down just over 12% year to date. It goes very much to your theme,
Yep.
BHP and Anglos. Are they telling us something?
Yeah, so I'll start out and explain how we look at companies, then we can overlay that on the various companies.
First of all, do you think BHP and Anglos are telling us something terribly negative?
I've got a mixed view. I like some of the assets in there and not some of the others. So we'll
All right, park that now,
We'll
you
get to
can
that
go.
shortly. So what we try and do in terms of the businesses we look at, we love buying high quality businesses. So these are businesses that generate high returns on capital and have strong barriers to entry so they can sustain those returns going forward. That's pretty simple. Most people want to do that. The second and harder part is finding the right price. So what we do is we look at the normalized level of earnings through the economic cycle and base our valuation on that. We like to have some tangible assets underneath if we can as well. So let's take that and let's look at the retail sector. So this is a sector that's done phenomenally well over the last 10 years. So let's look at the pricing dynamics of the companies there. So the first and most basic is a price to earnings multiple. Price to earnings multiples on retailers in South Africa are probably anything from 20 to 35 times earnings.
We could actually use the term shot the lights out.
Yeah. So a significant premium to the market. Okay. So immediately you're going to get a little bit concerned. Then you say, okay, fine. Well, where is that level of earnings? Well, surprise, surprise, it's at the record highs that the sector's ever done. I'm getting even more nervous. Then I say, okay, let's break those earnings down. Let's see how much these companies are making in terms of margins. Clicks earned a return on equity of 67% last quarter or last year. So that's probably around 3 times what a retailer should sustainably earn over time. So what's going to happen if a company is earning that high return? It's going to introduce competition, because why wouldn't everyone else try and earn a 67% return on equity? The only way that return is sustainable is if there is a barrier to entry. And in the retail sector, I find it very hard to find a barrier to entry. And we've seen that. Let's look what's happened. Walmart's come in. They've bought Massmart. Woolworths is getting into the more generalist sector. Everyone's trying to eat each other's lunch. So the competitive pressures are massive. Those are fantastic for a consumer, but that's going to hurt your returns.
Now, this is an interesting theory.
Yeah, no, it's totally right. It's totally and utterly
Low
right.
barriers to entry, increased competition, lower margin overall.
Yeah, what Nick spoke about earlier on is exactly what happened to the resource shares just before the crash, just before the global financial crisis. Companies were at slightly different levels, but still relevant. Anglos was at an 18 PE and earnings were at an absolute peak, but the forecasts were that in a year's time, earnings are going to be at 12 PE because the earnings are just going one way, and that's up. And of course, what happened is the next thing Anglos passes its dividend. Just earnings just disappear in front of your eyes. So very similar position for SA retailers at the moment. You earn very high earnings, very high margins, very high PEs. And Nick is 100% right. But exactly the same was the same a year ago, and the shares are up 20, 30%. So it is so difficult to be pure in investments, because you can be right, but before you're right, you might have lost your assets and your job.
Well, we
That's the
touched
problem.
on price to earnings ratio. We've also touched on return on equity. There's a third element that you wanted to mention. Wasn't there a third
Assets.
element?
No, I mean, look, an asset underpin is obviously great as well. You know, if you don't have the earnings, if you've got a set of assets, so that might be a property underpin, anything like that. But I think the key now is to say, okay, fine. So we've looked at most of the companies in that sector. Let's look at the resource companies. So resource companies, generally the valuation is driven by the price of the resources that they sell.
And look at what's happening in the platinum sector.
Yeah.
Suddenly they're pulling back on all expenditure because the platinum price is too low to justify it.
And this plays to that point exactly. So let's look at 3 specific
So
commodities.
you're not going to go and set up a platinum company tomorrow?
Not a mine.
No, I'm not, but I'm definitely going to invest in one.
Yeah, you might buy the shares, yeah.
So let's look at 3 different commodities. Now, the price of a commodity is driven by the marginal cost of extraction. Pretty simple economics. If a commodity is trading at less than what it costs to bring out the next expensive ounce or barrel, there's no incentive for producers to pull it out because they're going to make a loss. So production will go down. That means the price will have to come up because supply has gone down. So Eco's 101. So let's look at that compared to iron ore. Okay, marginal cost of pulling out a ton of iron ore around $100 to $110. The price of iron ore at the moment, I think when I last checked, around $140, $150. Quite a big premium. Okay, so what's going to happen? And by the way, it was a lot higher not too long ago. Everyone's going to go and bring more iron ore supply. And if you look what the diversifieds have done in the last couple of years, everyone's done that. So you've got supply coming up at a already elevated level. Why does that happen? Because everyone thinks China's going to consume from here to kingdom come and never slow down. So very concerning, the price of iron ore. And then we look at oil. Marginal cost of oil around about $100 now, just under 100. Where's the oil price? Around $100. So downside risk on oil, a lot lower. Thirdly, platinum. Marginal cost of extraction, well below $1,500. So actually below. And that means people are going to stop producing. And what did we see today? Eastern Platinum have canned one of their mines, and that's going to carry on.
And you're going to see a lot more of that coming
pulling back on their capital. But now, all right, great. I mean, this all makes perfect sense to me. But I want to go back to the retailers because they have defied the odds.
Yes.
And if this theory, so how long do we need to wait for the theory to come to fruition? Because right now, retailers, in terms of their performance, are disproving what you say.
Absolutely, and nobody knows, and maybe they will disprove me. But the odds are, and history has proved it, if you look at it over time, when you buy companies on high price earnings ratios at margins that are way above normalized levels, on balance, you lose. So the tough thing in this industry is to ignore that because maybe I'm wrong in the retailers and we miss out. But you know what? On balance, leaving those ones out will generate you...
Do you ever leave room in this very stringent theory for outlying factors, for instance, foreigners, and foreigners deeming South African retail stocks to be much cheaper than other emerging markets, because that could be a game changer.
It's a good point, but what drives equity valuations in the long term is cash flows. So it's all well and good if the foreigners come in because we're cheaper than Russia, but if our businesses don't deliver those cash flows, and they need to deliver big cash flows based on their valuations, those valuations are eventually going to drop. Yeah. It may take some time. So maybe a trader wants to come in and try and anticipate what someone else is doing from overseas, but it's not a game that we like to play.
Yeah. All right, another game changer. Let's put this to the resource story very quickly, and Wayne, then I'm going to get your comments, in that we've just heard, and well, we know that Europe consumes 80% of, not 80, half of South Africa's platinum. Now, Europe is not going to recover anytime soon. That certainly is on the cards. Whether they go for austerity measures, full out, still not going to have any traction for the economies in that territory. That, again, could be a game changer for 5-10 years out for platinum.
It could, but, you know, it's a cyclical phenomenon. So Europe's under pressure now. China's rising. You know, I'm not willing to pay any price for a China investment, but I do think it's going to be a phenomenal growth story. So Chinese consumption will take some of the slack out. And I don't think everyone's going to stop driving motor vehicles tomorrow in Europe. They may not have amazing, stellar growth stories, but people aren't going to stop buying platinum tomorrow. And the slack will be caught up. And it's got a lovely broad base. So there's AutoCats, it's used in televisions, there's some investment demand, there's jewelry demand. It's a nice broad-based commodity with a very restricted supply. So the barriers to entry to get into platinum are a lot higher than a base metal like iron ore.
Wayne, you were going to add.
Yeah, look, I mean, Nic's right on the retailers. They cannot essentially live up to their price. They cannot.
I have been hearing this now for 2 years.
And that was the next point I'm going to, is that you can be right over the 5 years, but lose all your clients and lose your job on the 2-year basis. So this is the problem with investments, as you know something's afoot here. Maybe you're wrong, but you think something's afoot here.
It's not sustainable where the retailers are concerned.
If you sell out today, you can look very stupid in a year or two's time, even though when you're sitting on your porch outside your house having coffee because you haven't got a job anymore in 5 years' time, you might think, oh, actually, I was right. But that's why investments timing is everything, and that's why you have to pay, and it's unfortunate, but you have to pay some heed to the mood of the market. Now, the resources we're chatting about. Anglo-American was cheap at an 8 PE a while back. Didn't stop the shares falling 15%. Didn't stop them. Now they're just cheaper. Are they cheap? Yes. Should you buy today? I suppose if you can afford to take a 3 or 5 year view, yes, you do buy today. But if you fight sentiment at your own risk, you honestly
Sounds
fight
like,
it.
that sounds like a tough game. Are you sure you want to stay in this industry?
But that's the beauty of it, Bronwyn, because it's all too simple. You know, we can lay out a very simple. So it's a very simple game. So how is it that value investing outperforms the market over time? It's because there are so many people who cannot afford to take that pain and wait.
Yeah.
And if you can, and if you've got the courage of your convictions, you can make a strong return over time. But it's all about the behavioral psychology behind it and saying, can I sit this one out?
Can you sit it out? Yeah.
It's tough, but if you can make a lot of money.
I mean, I've always maintained there's only one thing difficult about investment, and that's to get your timing right. That's all.
Absolutely. And if we could all get our timing right, then the index wouldn't outperform active managers more often than not, which is the reality.
But that's also a cyclical phenomenon, that.
All right. Well,
that's a bit of a secret.
Let's leave that debate, passive versus active, for another day.
Very simplistically,
I'll bring the fundamental indexation guys in here.
If passive worked, there wouldn't be an active management industry, and it would have died out a long time ago. So obviously, investors out there still think active management works. Otherwise, there wouldn't be an industry.
We're holding out for the long term. We're waiting for the long term, for value to be delivered.
Active asset management has been around for hundreds of years. It's not a new phenomenon. So I wouldn't follow the passive story too much.
Well, as I said, that's another whole debate. Well, you know what? Let's have that next week. We'll have that passive versus active debate next week.
I'm not against passive at all. I think it's a very good investment. But I'm just saying, don't dismiss active either.
No. I'm definitely not dismissing active. All right. So where do we leave it? What day are we today? This is Thursday.
Thank goodness.
Thank goodness. We've only got one more day, but don't we have the US jobs data coming out tomorrow?
Yes.
That's going to be a key indicator of what happens on the markets. Obviously, we saw markets selling off heavily yesterday. We saw some
bit of a recovery.
It was a bit of a muted day, really, across the board
but
today.
look, I mean, the market went up 1%. It fell 1.5. Now it's up. What did it go up today? 0.5, 0.6. So
neither here nor there.
It's not too much. But what I found interesting tonight is that the Dow's actually up, or it's marginally, it's neutral, and that's after the GDP revision number. You know, so it's not all bad news, certainly over the last day in the US, but tomorrow's data is crucial.
Tomorrow's data is crucial.
We've just discussed, how long these things can take to play out, but how you look at the underlying fundamentals. So really, a day or two's movement and one jobs data point it's completely irrelevant.
Noise, as Peter Viljoen says.
Yeah.
Ignore the noise.
Well, it's completely irrelevant. If I, what's the thesis on
the market
platinum?
doesn't think it's irrelevant.
And that's the beauty. So that's where Mr. Market, the manic obsessive person that it is, can either give you an opportunity, like in the platinum sector, or it can tempt you into trying to catch the retail train and getting burnt somewhere down the line.
What the daily, like tomorrow's data, what it will do is, personally, I believe that the US is okay. So this will either give me a little bit of confirmation or give me a bit of doubt, because long-term data is just made up of a whole range of short-term data. So you look at the short-term data to try and spot a trend to see whether you're right or wrong on your long-term stuff. So the short-term stuff is relevant, but the effect it has on one day's trading is completely illogical.
So again, we can look at
completely illogical.
What's going to drive the US economy? The housing market. That's pretty well known. So again, forget all the noise. Let's look at the housing market. New housing starts and new supply in the market has been at a record low for a record amount of time. Okay, so there are more people getting born in America every day. They're going to have to live somewhere. So eventually that oversupply that we have is going to get cleaned out the system, just like I've talked about the commodity prices. And house prices will rise. They're down 33% from the peak, so we can't call a bottom, but the fundamentals are there for that housing market to bottom out somewhere around here and eventually drive that market up. It is well priced. It might get cheaper, but it's pretty well
much
priced.
calmer than when we ended business tonight. We were terrified, then we're much calmer now.
No, we've never been terrified in our lives. Never been terrified. But I mean, Nic is 100% right. It's just the timing.